One of the biggest financial decisions we will ever make is buying a house. And when buying a house, one of the most important decisions you'll make is how to finance it. Hi, my name is Jack Goggin, and you are watching Jack's List, a show dedicated to bringing the average consumer the insider expert information into all things real estate. And today I am joined by a very good friend of mine and a lender in town, Josh Anderson with AnnieMac Home Mortgage.
Hi, Jack. Thanks for having me, sir.
So let's kick it off. The hot topic, but really the main reason we went, God, we really need to film a show. When are the interest rates coming back down?
That's a wonderful question, Jack. Next.
Yeah. So to be more serious, where you and I hear all day, every day, I am waiting for the interest rates to come back down before I'm deciding to make my purchase. Do you think that is a good decision, and what factors should someone be looking to?
It depends who you're talking to. So if you're talking to somebody looking for their primary residence, if you're trying to play the market, you're going to lose every time.
Yep.
You're going to miss out on deals. You're going to miss out on opportunities. And it might be for something that doesn't come or comes too late and the market shifts. Right now, we are seeing sellers' concessions. We're seeing repairs getting done. Doesn't mean that in November of 2025 that might shift and change. If you're talking investors, it's more important of a conversation to have. The truth of the matter is, it's one of those things that we have to do. And interest rates do one of three things. They go up, they stay the same, or they go down. And if they go down, we're looking at refinancing and other opportunities to save you money. If they go up, well, you get to brag about your 6.5% interest rate to your friends who have an 11%.
Yep.
So it comes down to what you are comfortable with. Is it the right time for you? It's a very individual thing.
Totally agree. And that's where it's funny. We've had conversations. We've done quite a few deals together.
Yep.
And often, I believe in a perfect situation, if you're a buyer, is you have a real estate agent and a lender that have a relationship. They know how each other works. They know the tricks of their own games, and they can collaborate on it. We've had conversations where we'll have a client who is spending $3,000 a month in rent, and they've been renting for the last 5 years. And we're going, yeah, it's 6.5%, but you have no equity today. You're better off just bite the bullet, plan on refining if it goes down, and know that you're comfortable if it doesn't. And then we have other people where we go, your current home has such a good interest rate. This just happened, 6 months ago, where we went, you have the golden handcuffs. We both recommend, after running the numbers, you don't sell that house because you may never see that rate again. And back down turn that property into an investment property, lower your budget on your next larger primary family house. And, here's what all the numbers say.
Exactly. And there are people that are looking to upgrade their houses, whether they had a child or a better job or something like that are in that situation to where their interest rate they bought in 2020, 2021, where interest rates were sub threes. And so they're holding a house. And I have one client right now who, same situation, they've had another child, they've outgrown their house, and they want to upgrade. And we have a program called Buy Now, Sell Later that allows you to basically buy your new home, and then after you close on that, sell. There's some caveat to it. It's a pretty good program. But when you looked at the numbers and looked at what they were doing, because that interest rate is so low, and his monthly payment was so low, keep it, become a landlord, make some money off of that rent. And there's a term for it. It's actually called accidental landlord, is when people have that where it's so low that it makes fiscal sense to keep that property, though they never actually intended to be a landlord when they bought that property. And so, but then I have another situation where we're doing what's called a non-QM loan, which tend to have a little bit higher interest rates than what your conventional FHA do. And they're business owners. They work primarily out of Melbourne, but they live in Kissimmee. And that percentage of interest rate, that difference in monthly payment is less than what they're spending in gas. So for them on those soft costs to change that over to live closer to where they actually work is huge. What tends to happen is people look at their mortgage and their house in such a vacuum that they forget about consumer debt that you can leverage that for, investment properties, soft goods like driving and toll roads and all that stuff. They tend to really isolate their mortgage versus the rest of their financial health, which that's what I'm saying. On a personal level, yeah, interest rates can, depending on your perspective, can be higher. So does it make sense for your family to make that jump? It's such an individual thing.
And I love that you brought up that, because again, you and I have gone through this together and, separately many, many times, where quite a few times I've had a seller reach out to me and go, "Hey, I want to sell my house." And instead of just going, "All right, you got it, here's the listing agreement," I go, "Okay, great. First, what are you trying to accomplish? What kind of house are you trying to buy? Let me look at where your property is valued right now. Let me look at what it's done since the time of your ownership. Let's see what your other options are." And before going, "I will sell your house," making sure you do the analysis to make sure that's actually a good idea in the first place. And it's pretty surprising how many people I've talked out of selling a house for X, Y, and Z reason. And I know together as well, I may do an analysis and go, okay, on my side of the table, I go, that's a very good decision. And then I connect them with you. And then we look at the finances and their income, and I'm planning, I should be getting a promotion in X number of years. And you go, hey, you know that you can either sell your house, buy a new one today, or if you wait in 2 years, improve your credit, here's the budget that you would be looking at. And in the area, collectively between the two of us, we go, you can do your original plan, but we think there may be a better plan for you. And we've done that many times.
Yeah, absolutely. And then there's this misnomer. There's a lot of people on the Instagram and the TikTok that is just saying, hey, go buy this house and you can use an FHA loan. And then you can, in a year, you can use an FHA loan for your next home. And then in a year you can swap. No, there are, yes, you can do that, but there are caveats and there are some rules that will get you stuck. And so when you're upfront about, if you're a first time home buyer and you're talking about those things, we'll set you up for success. We'll make sure that you understand what those rules are. There's a thing called a 99-mile rule, where doorstep to doorstep, that house has to be 99 miles away. So if you don't qualify for that, then all of a sudden we can't use that investment property to offset your income or offset that liability rather. So there's a lot of questions that need to be asked, and you need to be talking to people, not just on the new house, but the second house, because that will change your qualifications and that will change your interest rate, and that will change because as you move away from ownership, banks feel it's more risky. So they add, interest points to the interest rate, making it a little bit more expensive.
Yeah. And before we get into the nitty gritty, I want to give some context, because again, where I know you and I have talked about this show, and the purpose for this show is not to just be hey, here's this week's show on all things current news. I'm hoping this will be an episode that I can send in a year or two and there's still value there. So as far as interest rates, I know the common thing we hear all day, every day is that the rates are quote unquote high. Where are the rates today?
Great question. It depends.
Let's say a 30-year fix.
If you're looking at a conventional, you got good credit, it can range anywhere from the high 6s to low 7s.
Got it.
Usually you're paying a little bit of a discount point, meaning that you're paying a little bit for it. FHA is heavily subsidized right now, so they're going to be in the low 6s to mid 6s.
Okay.
If you qualify for a USDA, those are going to be in the low 6s, not costing much. VA has some really good pricing as well. VA for a 30-year, we locked one a couple weeks ago, and it was like 5.99.
Oh, okay.
Costing half a point. So it depends what loan type you are, but also it's not just that simple. It also interest rates based off of many factors, including your credit score, right? And it goes, if you have a 620 credit score versus 720 credit score, you're going to have different rates. Your debt to income ratio, basically how much how much debt you have, plus the cost of holding that home divided by your income. If you're 25% versus 56%, it affects your interest rates. Same thing with your LTV, so your loan to value. So how much are you putting down Are you putting only 3.5% down if you're an FHA, or are you putting 20% down? That will all have impact on your rates. So to say, here's what it is, the national average, honestly, if you just Google conventional mortgage,
Mm-hmm.
they're dead on with
Yeah.
where the national
I
average
think
is.
today it's
pretty close.
6.83 or something today.
Yeah. And just Google national average, and it's pretty close. But again, even doing that, sometimes it's better to take a higher interest rate because maybe I'm giving you a lender credit because you're taking a higher interest rate than buying the rate down. The rate is not always the best thing to do, is to buy it down. Because let's say, for instance, yeah, I can get you a 6.25%, but you're going to pay 1.5%, meaning you're going to pay 1.5% of the purchase value to get that 6.25%. Now, points are not, if I pay an interest rate, I'm going to get an interest rate down. That's not how it works. It's a lot more complicated. I'll go cross-eyed explaining it. But maybe it's better for you to not buy that, have the higher interest rate, take that $6,000 and pay off 2 credit cards, because now your monthly liability and your monthly exposure every month goes down. So you just paid off 2 credit cards. Yeah, your payment went up $40, but your credit card that you're paying off, that minimum balance went off, $140, $150. So now you're in the positive for that. But yeah, you got a little bit higher interest rate. So it's not always just a simple, straight answer. It never is, really.
Yep.
There is a lot of art to being able to do this.
This is a common trend on the show. And one of the reasons why I wanted to start it in the first place is often people have a question that the answer is always, well, it depends. And it really emphasizes the point of, here's why you should, whether it's from landscaping to building to lending to insurance, you need someone who really understands the ins and outs, knowing that almost all of these worlds are far more complicated than most people assume. Yeah. And you just need an expert to explain things in layman's terms. If you do this, it's this. If you do this, it's this. On an individual basis, what do you think is best for you?
Absolutely.
And to circle back to the interest rate, and then we'll get into some of the misconceptions. So let's, we're sitting around 6.8 average, 30-year fixed, conventional today. Do you agree with the narrative that the interest rates are high? I hear that frequently. I have my opinion, but I want to know what you think about that.
I will use my terms and choose my language very carefully.
Please.
Do I think that it's all your perception, right? So do I think that it makes it harder to buy a home? Sure, absolutely. But in Florida, so does insurance. So does having the intangible tax. Because we don't have state income tax, we get charged an intangible tax. That's how the state makes money. It makes it harder, but is it impossible? No, it happens all the time. I think when we're looking at interest rates, to be hung up on one thing out of many, many different factors that go into buying a house, and we're forgetting the amount of equitable growth that happens historically in Florida is more than 4.5%, which is higher than the national average, and it continues. So you're missing out on the equitable growth. And I've showed you a study before that when you take, if I buy a house now at 7.5%, 7.5% seems insane. Mm-hmm. But if you buy a house now at 7.5%, and in 2 years you refinance it to a 5.5%, the amount of money that you spend, adjusting prices for 3% growth every year, the amount of money you spend at 30 years, not adding any payments versus waiting 2 years for the 5.5% interest rate to come down and then buy that house, is so much difference.
Yep.
So
time in the market, not timing the market.
Exactly. So people get hung up on something that, you can't control. It is what it is. Yeah, I would like to see them go lower. It makes it easier. Mm-hmm. Every quarter of a point, more and more people come down. When you get into below 6s, it's something like 24 million more Americans are now eligible to buy a house. Mm-hmm. It makes it easier.
Yep.
But it doesn't mean that you should stop and wait. You should be doing what's best for your family. And sometimes, you're in a good situation where, pausing for 6 months is the right answer. Sometimes it's not. It all depends on your personal journey.
Yeah. And my take on interest rates are high. Therefore, this is maybe the only reason I'm deciding to wait, not because I can't afford to, where it's just a hyper fixation on one point. And my take on it is, over the last 50 or so years, the truth is the average interest rate is right around 7%. So I go, well, I wouldn't call it high interest rate, where it's a historical average, slightly below average. We saw, what was it, in the 80s, we saw it go all the way up
13.
to 18,
Yeah.
18, where I know even my broker, he bought a house and he had an 18% loan on it. And the other part where I think it feels high.
I'm going to pause that on
Please.
there, though, but I'm going to also interject with that it was 18%. But it was a little bit easier to buy a house there because of income and home prices and stuff. They weren't as skewed as they are now.
Yep.
So even though it was 18%, it was still manageable. But it's a little bit easier than what it is now when you consider that factor, because the percentage of home ownership and home value in your average mortgage on incomes based back then versus now, it was more in line with where things, in my humble opinion, and most economists say, that you should be spending on housing.
Yep.
Whereas now, yes, they're still sitting at 6, but the other factors, including income, job losses, those type of things, cost of foods and goods and services, have gone up as well. And so that percentage kind of gets a little skewed when people make that argument. It's still a valid argument where they're kind of moving around.
But we're not in the same condition.
But it's not the same. It's like playing football and then Canadian football.
Totally.
Like same sport, a little bit different rules.
Different conditions here, where totally agree. And the other part, and I think where a lot of the high interest rate, where if we went back to 2017, and the rates were up around 6.5% when they're like 5%. Where then you go, they're higher. I think it's tough when we're just coming out of COVID time, where record low interest rates are like, it's doubled. And it's like,
you have a government that, because of necessity, said, hey, we're done. Nobody go to work. Nobody do anything.
Yeah, we got to shut down.
They had to massively subsidize everything.
Totally.
And they predicted completely wrong by their omission. They predicted things and dropped rates to 3.25 to sub twos in some conditions. And so that caused a massive backlash. So you're seeing a correction of those, the COVID behaviors, like, employment stuff, we're past that. But as far as economy, we're still seeing some of those tools play out.
Totally.
And Fed is very slow. They're being dovish, meaning that they're kind of softening, but they're still very slow to respond. And they, in their own admission, they continuously get it wrong. Under Powell's own admission, he's said it multiple times where, we missed that one. And under their own admission, they're using antiquated information that is, when adjusted, is so wrong. It's where the experts are saying it is, and then they get the information so wrong. So that's having a play into this. But again, it goes back to what is right for your family.
It's so individual.
Only one small percentage of what is going on.
Yeah, I think there's a overemphasis on specifically the interest rates. It's the main thing I hear. Second to that, and I think the bigger topic that should be talked about is prices are high. Where I go, if we just saw such an increase, especially in Florida. I mean, what was it? 2023 home prices went up like 17% in town.
I think that it's not necessarily prices being high. I think the amount of low cost starter homes have kind of been washed out.
Agree.
And there's a couple plays that factor. Like, you have our parents and grandparents are living longer in their home. Builders from '08 really haven't built a lot of stuff because of many things. They are building now like gangbusters, but it's kind of slowed down what they build. So then you have parents that now their children have grown up, they're in college or moved out of the nest, if you will, and they're moving back down to those smaller starter homes and downsizing. So it's harder for inventory for people to get in there. And there's a lot of places where building smaller homes or first time home buyer homes that are cheaper pricing, not quality, but pricing, isn't as lucrative or subsidized as some of the mid-tier or luxury homes.
Yep.
So
Where
if
it's
you drive
that
around,
600 to 900.
Yeah,
Everyone
yeah.
loves 600 to 900.
So
Under
that is
400 is hard.
That is playing a major part of it. And then you have some houses where the repairs are just too expensive to warrant the price.
Yep. Or
So-
like condos, the condo fees, where early in my career and when all my friends were freshly out of college, specifically the single women, young professionals, condos were the move.
Yep.
You know, yes, it was $150 a month, but you don't have to mow the grass. You get a pool, you get a gate, you get all these things. Now, I just listed a condo that they just lowered their condo fees and it's still $690 a month, where I go, that used to be the $200-ish thousand house that, you know, a young professional could get in and comfortably. And now I go, that becomes priced like it's a $375,000 house. I'm
And
like,
so some of those $300, $325 homes, now all of a sudden that $185 or $180,000 condo
Yep.
is actually more expensive than the $325 home.
Totally.
And then that's even if you include like landscaping and stuff like that. So yeah, there's a big change that happened with condos that have made it quite difficult. Not to get into the weeds on that one.
Yeah.
But it has
Building falls in Miami.
two.
Two buildings fall in Miami, and everyone snaps into action.
As they should.
Yeah,
There was a
agreed.
lot of, they didn't want to raise prices, and a lot of deferred maintenance. Not everywhere, but you live on a coastal area. Salt water is damaging to concrete. You have to be on top of it. And so, but nobody wants to raise HOA fees. It's not a good look either. So
Yeah.
it's
And the good news with it just being boots on the ground, where like last year I had a condo listed that should have sold this sucker in a week. It took like 9 months. And it was the fees. It was the fees that really killed it, or the inability to get financing. Good news is what I'm seeing around town in that segment is the fees are coming down. They had to jack them up to build up reserves to make these repairs and bring everything up to code, you know, based on these changes in
and a thing called
regulation.
special assessments where it's just a small amount of money for a little bit of time,
Yeah, and
or a lot of money for a little bit of time.
totally. And they've taken a hit where prices, I mean, now I've seen a lot of condos sell for 20-25% less than they should have, or they did just recently. Now some of my savvier investors, we're starting to look at the condos now that we're seeing the prices go down. We go, ooh, we can get in a really good number. Luckily, we sold them all after the Miami thing. I told all my condo owners, I went, we might want to let's sell them. They got a great number, and now they're all going, we should pick some more up again.
I just put an offer in on one as an investment property.
I like it.
And they bought it in September of 2021. And I offered them $1,000 above what they paid for. And the guy's like, that's what they paid for. Okay. Look at your condo fees.
Yeah.
Like, if this was 2021
Are the condo fees the same?
fees,
No? Yeah.
Yeah, it would be a different scenario. So yeah, for savvy investors, if they're paying attention to what's going on legally, like
That's the big part. You got to know what's going on with that
gotta watch
association.
what's going on with the legal stuff with condos. You can get some really good deals. And same thing with primary residence. But right now, if you want that lifestyle, it's worth it. If you're looking for a cheap alternative, they're no longer a cheap alternative most of the time, and they're harder to finance. There's less programs and availability for them. There's less cutesy clever lending
Yep.
that goes into them. They're tricky.
Totally. So let's dive into some misconceptions. These are lines that I've heard from our own generation many, many times over. I'm sure you have too. And I think a lot of them kind of date back to the 80s and 90s that I just want to discuss with you. So the first part that I have, this conversation I mostly have with first-time home buyers. And that is when we start talking about their purchase, they in their head are going into it assuming they have to put 20% down. To obtain a mortgage, do you have to put down 20%, and should you put down 20%?
No and no.
Yep.
there are programs like USDA and FHA that allow for 100% financing. That doesn't mean you're not coming out of pocket something, because we collect taxes, we collect your property taxes, we collect your homeowner's insurance. There's some underwriting fees. Again, we don't have state income tax, so there's intangible tax, titles doing things. So there's stuff that are paid, but you're able to finance 100% of that house if those houses qualify, or you qualify for that or you qualify for that program. Generally speaking, FHA is 3.5%. That's it. And conventional is 5%. Now, there are some caveats to that, to what we can change. There are some programs that kind of minimize that, change that. The second part of that question, as you put more money into it, that is one factor that they look at for risk tolerances, because it's not just, here, I'm putting this in, my credit score is this. They look at everything. They look at your down payment, how long you've had credit cards, how long you've had these things. It all plays in. So sometimes you have to put more in to qualify, or for various reasons. 20% down. Again, this gets into the, how do you structure a mortgage to make it advantageous for your financial future? Let's say you're buying a $300,000 home, and you are going to put 20% down because you think mortgage insurance is bad, the devil, because we've all been taught debt's bad. Mortgage insurance is bad. It's not. It's not punitive. It's not a punitive measure when you realize how to use it. Mortgage insurance is a tool. When you stop thinking of it as a punitive measure and think of it as a tool that you can utilize, it changes the picture. So we have a $300,000 home. We want to put 20% down. Okay. Well, I would challenge you, if we can qualify for it and look at it, let's put 15% down. Your mortgage payment's going to go up slightly. Of course, you're going to have mortgage insurance, of course, but your payment might go up, $80 to $120. But you're not bringing $15,000 more to closing tables. So you're going to keep 15 grand in your pocket versus the $180 to $130 a month. So if you factor that out, the difference before you see a net benefit of that, it's almost 18 years. So you can take that money, and at that percentage is something like 2.5% growth or something like that. There's other ways that are more lucrative to invest that money. Again, but in the flip side, if we're trying to make a payment, if we're qualifying, it's such an individual thing. So it depends. Generally speaking, there's a weird glitch in how securities are traded, that 15% on a conventional work. Sometimes putting less down is better. It all depends.
Yeah. And I know personally, so you have a young family. I have a daughter on the way. Where often with the younger generation, or the first time home buyers, or people that are still in that building stage, often I go, well, certainly if we're under 7%, normally I compare the interest rate to, if you took that cash and put it into another investment platform, let's say stocks averaging 7% return annual, where I go, well, if you can put that money and you don't need 100%, I'm going to get 7% back on the stock market. Don't be irresponsible. But if the stock market's going to return a little bit better than it cost you to borrow, I say keep the cash. If you need to sell, you can access it. And that's the other big part with the younger generation. I go, there's great value in, once you put that cash down payment into the house, you're not getting it back unless you sell that house or you start pulling equity out it. And it's no longer accessible. If it's in the stock market, you might have to pay capital gains but you can access it. If something happens in the family, or wife or husband loses the job, accessibility to cash, I think, is really, really important when you're young.
And you can always pay more on your mortgage.
Correct.
And you can always take that lump sum and dump it into what's called recasting.
It gives you more options, I think.
That, but recasting is where you take a large lump sum, throw it at the problem, and then they recast your payment based off of that new balance. Not every loan program is eligible for that, but I mean, it's still something that's available.
Yeah, and often the clients that say they want to put 20% down, I explain to them, do you understand what you have to, or, do you have a reasoning on why? Often the ones that I agree with, they go, I have hundreds of thousands of dollars. I have, 400,000 in the stock market. I just want diversification. I have cash to spare. Let me just put it in there and have a lower monthly. And I go, okay, cool.
Exactly.
Just want to make sure you know you have a reason why.
Yeah. But somebody like, it's your first time, this is going to wipe out your savings and you got little kids. Maybe, not guaranteed, but maybe it might be better to have cash in pocket.
Totally.
So, but again, it's such an individual thing. That's why working with somebody who understands how to communicate this stuff and explain it is important. And then sometimes it's even better to make sure that my conversation is coupled with a financial advisor as well, to be able to like, hey, is he doing this? Because I'm not a financial advisor. I just know a heck of a lot from both personally and working in this. So I'm not certified, but I got guys on speed dial that will look at this stuff and go, yeah, he's right. Or, hey, if you think about this and this and this, it might be a better way to structure it too. So it's knowing how those tools are, because it's such an individual journey.
Totally. And the other thing we hear frequently is you have to have a 700 credit score. Is that accurate?
Nope. No, not at all. Not at all. Minimum credit score is actually 510. 510 comes with a lot of caveats. So it's really hard to qualify if you have a 510 credit score. FHA wants to have a 580 credit score. Conventional, there are some programs that allow it for lower, but generally speaking, conventional is 620. Depending on your credit score, though, is going to influence your lending program, the programs available to you, and your interest rate 100%. So 580, you're ready to go. Like if everything else goes. And then while we're in that process, we're also going to build your credit if you're getting there, because we want to get you even better. It affects a lot of other components of your life that you don't realize, like when you get utilities turned on, how much of a deposit you have to have. So even if you're qualified, we're still going to build it. But once you get to, 720, 740, not much of a difference, but there is a huge difference of availability in programs from a 580 to 640. So if we're at 580, our goal is to get you to 640. But it doesn't mean that you're not eligible. It means let's start the journey. Let's start going. Let's keep building credit, get it as good as we can, but you're eligible. But no, the 700 is Aunt Mildred bought her house 43 years ago and is telling you stuff. Rules and regulations have changed a lot in just 2 years, let alone 30 years ago. So her insight's insanely valuable because she's been through the system. She understands what it is. But a lot of the things like these myths are very outdated and antiquated. And another one that this has actually shifted quite a bit in just the last couple years, and that is the belief that a buyer should probably not use FHA or VA if they're a veteran because it's going to make them unattractive to sellers. I have my opinion on it. I want to know yours. And we've dealt with this with buyers together. Your opinion. What's your opinion? As somebody who represents sellers, if you get a conditional contract versus a VA or FHA, how would you look at that?
So looking from a seller's perspective, FHA and VA, they come with, as many things do, with some caveats that I think it's valid for a seller to be concerned about, such as the material condition or maintenance of the home, how old's the roof, or polybutylene pipes, where if you have FHA or VA financing, they have much stricter rules and regulations on obtaining approval. Please.
I'm gonna nail you right there.
Okay, please.
What do you think the conventional guidelines of the roof are of how many life years that it has to have left?
5.
No, conventional's 2.
Oh, really?
Yep. You want to know how many FHA are? I said it backwards. Conventional's 3 years. 3 years left of the life of the roof. Conventional's 2. I'm saying it backwards again.
Yep. And the insurance is 5.
FHA allows for 2 years left of the life of the roof.
Yep.
Conventional's 3 years. So if you have an older roof, it's actually better to go FHA. But there's a very good chance in Florida that doesn't matter because insurance is 5.
Yeah, it's going to cover it anyway.
Doesn't matter.
Yeah.
Doesn't matter at all. The second thing is you said piping, plumbing.
Insurance again.
Insurance.
Yeah.
It's not a loan type. It's not a loan condition. We look for the condition of it, make sure it's leaking and not safe.
Yep.
But Insurance.
Yep.
Same thing with if you see double tapping on electrical boxes where they're running 2 wires off of 1 breaker. Is that a lending thing
Nope.
or is that
Still an insurance issue?
Insurance. So
Yep.
most of the issues you're going to run into on the condition of the house is 100% insurance.
Yep.
Yes, there are things that happen in an FHA and a VA loan that aren't necessarily standard for conventional, such as for VA, you have to have a WDO study, wood dwelling organism study.
Yep.
But guess what? FHA
Most people do
conventional,
anyway.
when they do the appraisal, they're also looking for wood rot.
Yep.
So
And
it's the same kind of thing. So there's this misnomer that conventional buyers are more qualified.
Yep.
But I would tell you that FHA buyers, the interest rates are so subsidized that you have second homes that are selling their first home, buying a home,
Yep.
that are using FHA because the interest rates are so subsidized by a point,
Yep.
which will offset your mortgage insurance unless you're putting 20% down.
Mm-hmm.
So I would challenge the fact that no, there are differences of how the loans process. Like when you do the appraisal, yes, there is a checklist that an appraiser has to go through.
Yep.
But if your house has hazards and issues, conventional's not getting around it.
Mm-hmm.
How you get around those, so let's say your house has massive issues and you don't have, like an inheritance. We see a lot down here of inheritance properties and the family doesn't have money to fix it.
Mm-hmm.
The way you get around those is by doing what's called a renovation loan.
Mm-hmm.
Now you are guaranteeing the bank that you're going to bring this up to standard, HUD standards, minimum standards, after closing.
Mm-hmm.
So now you can buy that house that has all these hazards, that has a giant hole in the roof, that normally it would only be cash buyers.
Yep.
But as from a listing side, I have called multiple listing agents and they're like, oh, the roof's old. Okay, cool. That's insurance.
Yeah. Yep. Totally. You're going to run into that issue anyway.
So
So you just hit, because we've worked together with VA and FHA buyers. That's exactly what both of us go to the listing agent and to try to convince them to accept our clients. And all those points are valid. I would say the difference, and I think the difference from a conventional to FHA, VA is certainly exaggerated. The difference is with listings, most of the deals I've had where something comes up that maybe is an insurance issue, I can get the buyer to talk to the insurance company, make a deal with them. Hey, we're going to correct those issues in 30 days, where it's really not on us or myself or my seller to go, freaking deal with it. You can figure it out, go figure it out. There's less ability to do that with FHA and VA.
I disagree.
Really?
Yep, 100%.
Oh, I've ran into more issues with it.
Insurance doesn't care what loan type it is.
True.
So if you have, let's say, I'm not an insurance agent. I'm the preference app, but let's say I have one right now that there's an electrical hazard. They have 5 days from purchase to be able to fix it, and it's a VA loan.
Yep.
So it's not a lending thing. It's not subject to, so it's not on the appraisal, and it's an insurance thing.
Yep.
And they're giving them the grace period, and it's a VA loan.
Mm-hmm.
So it's not a conventional. When we do insurance and we help shop for insurance for people as a courtesy, and they're still shopping their own guys too, but we're like, hey, here's people that I've worked with before.
Yep.
Chat with them too. It's not a lending thing. They don't care if it's FHA, conventional, VA.
Mm-hmm.
So even those type of things are changed.
Yep.
And the only difference that we have with FHA and VA is really who backs those loans. So conventional loans are really backed by the market, whereas FHA is backed by the government.
Yep.
That's the difference.
Totally.
So you have different guidelines of how student loans are. That's why people are like, oh, it's an FHA is a first-time home buyer. No, it's not.
Yeah.
There's just different guidelines. For instance, if you have a private road, FHA is a nightmare for private roads.
Yep.
There's other programs in conventional that are a lot easier and a lot friendlier to deal with a private road. So in that aspect, there's a huge difference for a selling agent to go, hey, or a listing agent rather, to go, hey, you live on a private road. Let's make sure the lender knows this. But it all comes down to communication.
Yep.
Ultimately, I need to be communicating with the buyer's side. I need to be communicating with the seller side, and I need to be advocating for our buyer.
Mm-hmm.
And if I'm not doing that, I'm not doing my job.
Yep.
Because there is a lot of changes that have happened, and it's not your job to keep up with those. You should have an idea, but it's my subject field. It's
Yep.
my expertise and it's my job to educate you guys.
Mm-hmm. And I would say we're going back to FHA, VA. From the seller's perspective, if we go back to when the market was really hot, go back 2 years ago, 2021 to 2023 when it was crazy, where even if sometimes I'll have a listing on a house that's just so damn solid that I go, we really don't care about FHA or VA, where there's, I'll go through the whole list of VA requirements and I go, it's basically a new house, not worried about it. Back when the market's really hot, top guy is cash if he's coming in with a good number. Second to that, conventional, where it's at least less hoops to jump through than FHA, VA, where it's simpler. Where nowadays the market is, it's not a crazy seller's market, where sellers have to be a little bit more flexible, I think, to have a good result today. Now I'm seeing and I'm encouraging a lot of my sellers, unless we have a house that is a handyman special where you pretty much need to sell to a cash guy. I say, if it qualifies, I wouldn't be too worried about FHA, VA. Buyer side, we've done plenty of these deals together.
Well, even the handyman special, there's an avenue to be able to buy that as a FHA,
True.
VA,
Yep, with a reno loan.
Yeah, with a renovation loan where you're taking on the work and you get that nice kitchen. And the benefit of that, especially for first-time home buyers, when you do the appraisal, you actually use the after completion value. So you're using what you're going to do to the property to develop the value of the property.
Mm-hmm.
And so you get to see the equitable growth right then and there.
Yep.
Instead of going, well, I think I get 80% of the return on the kitchen. Like, you get to actually see it in paper.
Yep.
And it's a great way because you're usually taking a house that's underpriced because there's issues. And being able to build equity. It's great for first-time home buyers.
Yep.
They're tricky. You gotta listen to the lenders and the teams and have questions and be very engaged, but they're great programs.
I honestly think where the point of this podcast was really just to, scratch the surface. And as you and I do all the time, as we get on the phone and we dive into the weeds.
We're down in the rabbit.
I think where I think at some point we need to do another podcast and really get into, I think, the programs. It's such an interesting topic, but I want to keep rolling with just that surface level. Or stay tuned for part 2, because I really want to get into that. So let's talk about when somebody has decided they want to purchase a house. They know they're going to finance. They're not going to pay cash for it. What should they do, or what questions should they ask when trying to decide which lender they should hire to represent them?
I will tell you, if the first thing out of a lender's mouth is, here is my interest rate, hang up the phone.
Okay, why?
Because it's such a small, it is a very important part, but it's such a small part.
Yeah.
And if they're selling the interest rate, they're sales.
Yeah. What are your fees?
Yeah. What are your fees? This is how much I'm going to charge you. My job when I do that, when I take these calls, is I'm to educate. I had a really bad experience with my first loan. I worked in entertainment, rock and roll. I was touring. I had taxes that I had to file in 27 states. And I had no idea what I was doing. And the MLO couldn't even remember my name, Jack. She called, and when I went to fire her, she's like, Sean, I don't understand why you're saying this. So first off, my name's Josh.
Yeah, who's that?
No, that was a typo. No, John's a typo. Yeah. Jose's a typo. Sean is wrong.
Yeah.
So my first job is to educate. There is so much that goes into it. Yes, on surface level, it's simple. You ask for money, we give you money based off qualifications, but there's a lot of nuance.
Mm-hmm.
So you want somebody who's going to be able to sit down and explain things. Have them explain what interest rates are. Have them explain how your monthly payment works.
Mm-hmm.
Have them explain if you are in an HOA, how that works. Have them explain cash from borrower versus closing costs versus your down payment. These are all different things that they should be going over. Have them explain their process to you. So if I take an application, I'm going to take an application. I'm going to grab supporting documents. I'm going to then look at everything. I'm going to build your profile, look at different programs, then I'm going to send it into an underwriter.
Mm-hmm.
Is that the same for everybody? No. I'm document heavy up front because I don't like surprises.
Mm-hmm.
But have them explain their process. If they start talking numbers on the very first call, hang up.
Really?
It's not what you're needing.
Mm-hmm.
Now, I will tell you, I will be asking, I don't ask you how much you want to spend. I'll be asking you, give me an idea of what you're looking for. Give me
Yep.
an idea of what your minimum payment is and your absolute max is, because then you can back into what they're affordable.
Yep.
But I'm not asking them like, hey, here's my fees, here's this. That comes second. The first part of this should be, let's find out what's going on. Let's find out what your needs are. Let's find out what you're trying to achieve.
Mm-hmm.
And if that lender is not doing that, goodbye.
Got it.
If they tell you, oh, you can call me anytime, day or night. Really? I have kids.
Yeah.
The correct response to that is, I will return calls in a very timely manner.
Yep.
Right? I don't let things hang.
Yep.
Sure, we all do every once in a while, but generally speaking,
There's a certain level
yeah.
where you're clearly not busy enough.
Yeah. But those type of things. The other thing they need to ask for when you get into the interest rate conversation, I can tell you, hey, I have a 5% interest rate just as a marketing thing.
Yeah.
As long as I have a little qualifier going, this is based off of
How many points down?
810 credit score. You're buying 2 points. The house's LTV is this. As long as I have all that qualifiers, I can tell you whatever I want.
Yeah. It's a trick.
And then there are companies, and you can look them up. There are companies that like week before, they're like, sorry, the market tripped and now you're stuck.
Mm-hmm.
So ask about points. And what people hang up on is you keep bringing it up, interest rate. The real thing you need to ask for is what your annual percentage rate is, because that's actually more important.
Mm-hmm.
It's simple compounded interest, but it's more important, or simple interest, but it's more important to know what you're going to pay at the end of the year than it is per month.
Yeah.
When you're thinking about financial strategies.
Yeah. What is my bank account going to feel? Not just this one number on the page.
Yeah.
Yep.
So, and then strategies to help get that down. Now, they should be going over all these programs, and the first conversation is like a discovery call. Like if I'm a detective trying to solve a crime, I'm not going to go, here's what I think is going on. I'm going to go, hey, here's who I am.
Yep.
Where are you in the process? What have you learned? Tell me about yourself. I don't talk a lot up front. I let them explain what's going on. And if somebody is trying to just take the conversation, red flag, right? So it's in service to. So when you're shopping, the first thing out of their mouth is interest rates. Goodbye.
Yep.
Now, when you get to that point, ask and explain how it works. And if they give you an insanely low rate, like if they're going, we can get you a 5.5, lock it today. We can't do that.
All of a sudden. Well, there's caveats to it.
Yeah. So.
Yeah, where I agree. And it's very similar to how I run my business. Is the first conversation is, tell me what you're trying to accomplish. And I have some questions I need to know about yourself to see if, one, it's feasible, and two, if maybe there's a better option out there, or maybe doing nothing is better. It's really discovery for the person, trying to figure out, what is my client looking to do? Do I think it's feasible? Is there a better option? And it's one of the reasons I refer so many people to you is you may have a plan. I'm going to connect you with Josh, because Josh is going to be able to tell you if your plan is bang on, if you should totally not do the plan at all, or hey, there might be this, I don't know what your plan is, but we have this other alternative. Would that be more attractive?
And another thing that people forget is, or people get really nervous about, is us pulling their credit too many times.
Yep.
And when you do your credit, it's not the same as a car dealership where they're doing like buckshot it. So it's a hard credit pull.
Yep.
We can do soft credit pulls too, or we can go off of your information that you provide. If you do a hard credit pull, the expectation is that you are going to shop. So you're not supposed to get hit per every hard credit pull within 30 days from a lending institution. Doesn't mean that it doesn't happen. And then you just say, hey, credit card company or credit bureau, fix this. And they have to fix it. But reality is don't be afraid of talking to 3 or 4 different lenders or even 2 lenders, um, just because, A, you're going to learn something.
Yep.
There is hands down, every single person approaches every single problem differently. They're going to learn something. And B, don't be afraid, because it's not really going to have a negative impact on you just having a conversation.
And as far as I know, you and I harp about this with our clients all the time, is preparation, and start it way before you're actually trying to make the purchase. What should somebody, let's say often it's first time home buyers in my experience, what should somebody do a year or 2 years before they're planning on making their purchase to prepare to either get a good interest rate or maximize what they qualify for?
Talk to a lender.
Talk to a lender.
Talk to a lender.
Yep.
Work with the lenders. It's not, I'm an advocate for you.
Yeah.
I'm an advocate for clients. It's not an adversarial relationship. There's a thing of like, don't buy a car. Correct. But there's more to that sentence. Don't buy a car without talking to your lender. Like, we need to be included in these things to help you maximize. That's the biggest thing. Talk to your lender.
Yeah, and that's for fixing or improving credit.
Jobs.
Yeah.
If you change positions, it can have an impact on your qualification. Massive income change on income calculations. So if you are in the process of changing jobs, make sure you're communicating with your lender.
And I know over the years, there's been quite a few times where I have a client who's ready to make a move. I connect them with you. You dive in with them, and we end up deciding it would be really smart. Let's push back our timeline 6 months. Let me do a credit check. There's that credit card you can pay off. Here's the car that you can pay off. You have the cash. Here's the, you're financially sound, but based on what the bank is taking into consideration, do these things. And 6 months later, we're going to be in a much better position.
Way more advantageous.
Yeah, where I think that's the best advice is find a really good qualified lender, whether it's, it might be on the other side of the country. If it's in Central Florida, please, I'm telling you, call Josh and ask them what you should be doing to start improving your qualification.
Yes, because most people, especially when it comes to credit building, most people just dive into, I'm going to pay everything off. It's not always the right answer. Sometimes we want that because we want that revolving debt, because sometimes it's about the utilization. Maybe you don't have enough utilization of your debt. So paying off those balances might actually be the wrong move in your particular case. So the way I put it is, if I'm going to Miami, I can head south and eventually I'll get there. But the faster I put that in my GPS, the more quickly I'm going to get there, the more cost effective I'm going to get there. So the sooner you go, hey, I'm going to do this, the better.
So in closing, where we just covered a bunch of really good stuff, I'm really excited. We got to do a part 2. I just want to, again, with this opening, one of the biggest financial decisions most of us will ever make in our life is buying a house. One of the most important decisions when buying a house is the financing. And it's one of those worlds, in my experience, some people, they're wealth managers, they're financially very savvy, and often I just go hands-free. You probably know more than I do on this world. I'm just the real estate agent. But for the most part, most people I talk to, they really don't know as much as I think you should about this world. And I really want to shoot a part 2, get into some of the nuance, because I think it's just so important. So in closing, is there any closing advice or warnings, or what's the most important recommendation you can make the average audience?
Talk to your lender.
Yeah.
Communicate with your lender, ask questions, be engaged. Just work with your lender. Don't try and be cute. Don't try and hold things. I'm not here to judge.
Yep.
I'm here to help you.
Yep.
So you might go, oh, I had a hard time with credit. Okay, cool. Great. Let's right that ship and let's get you going. If this is the dream, let's do it. So talk to your lender, keep in communication with them.
Yeah. And I second that, where most deals where I feel most comfortable with a buyer, that buyer is talking to the lender as much as they're talking to me.
Yep.
And I go, good, where I have everything on the brick and mortar, the real estate side, but the money side is so important, where communicate. I just love that. Thank you so much for watching. If you would like to get more information from Josh, I will include his contact information below. And until then, I'll see you on the next one.